Good morning, everybody, and thank you very much for joining us today. We're going to be, if you have any questions, please do put them forward, and we will pick those up at the end. And if we can't get to them today, we will come back to you. Okay, so don't know about you, but it seems a long time ago now since that historic announcement on Christmas Eve that a free trade agreement had been secured between the European Union and the UK, and what fantastic news that was. We all know the serious consequences that tariffs would have had on businesses' profit margins. So we great position to be in. Of course, a free trade agreement means that goods which meet the UK and EU origin goods that meet the rules of origin can be sold tariff-free. But today we're going to be looking at the reality of what the deal means for businesses, because what doesn't change is that all movements of goods between the UK and EU, they are exports and imports, and that means that those customs declarations and paperwork and that additional cost, unfortunately, remains in place, and we all need to be able to navigate those challenges. And there's also the VAT issues. They do not go away. Jonathan and Marissa are going to be talking about the VAT issues. Getting those wrong will have a catastrophic impact on margins, and it really is something that businesses need to get to grips with if they haven't already. There are two really key changes and complex areas which obviously bring concern with them, and those are the origin of goods and the Northern Ireland Protocol. Andrew is going to be taking us through the maze of the origin rules, and it's a big hot topic that will be very, very important throughout this year as businesses get to grips with it. And we're joined by Angela, who's going to be discussing the rules relating to trading between Great Britain, as we now are, GB, as far as the Northern Ireland Protocol is concerned, and Northern Ireland businesses. Again, an area of a lot of complexity. So shall we warm up with some of the issues that we've previously talked to you about, and now that we're post-Brexit, we can now start to implement them. So on the next slide, please, we've got the UK customs tariff. So Andrew, what can businesses expect from that?
Well, obviously, because we've now left the EU, we've got our own customs tariff, which was announced in May last year, and there was a separate website that was set aside for that, the UK Global Tariff. From the 1st of January, everything's now been put into the customs tariff website, and it's been split into two parts. So we've got the GB tariff, which relates to goods being imported into Great Britain, and if they're imported to Northern Ireland. But if the goods are going into Northern Ireland, for instance, from Great Britain, then there's a separate side tariff for that, which provides the EU rates as part of the sort of Northern Ireland Protocol side of things. So all the easements that were introduced in May or announced in May have now been included in the customs tariff. So the duty rates have been amended to show the bandings as discussed before. So 2% bandings up to sort of 20%. So they're simplified. The nuisance tariffs under 2% have been scrapped. So everything's now been put into that new tariff. As we've now got agreements with the EU and also Turkey in the last week or so, they're now shown on the website as well. So if you've got UK goods or EU goods coming into the UK, then it will be under a preferential rate, and it will show the preferential rate on the tariff. So that's the update on the customs tariff side of things.
Thanks, Andrew. And I think it's really important that businesses familiarise themselves with that. It's easy to get into. We've got the website link up there. And as you'll see when we start to talk about origin, really, really important to get to grips with. We move on to the next issue. Postponed import VAT accounting is something that we've talked about before, and it's now in. So it's a really great facilitation measure for all businesses, so overseas EU businesses as well, that are registered for VAT in the UK. It means that no import VAT is charged when you enter the goods into the UK, but you need to formally instruct your agent to declare those goods to postpone VAT accounting, otherwise they won't, and you'll get charged import VAT. And that's often an email to the agent, and you know, we've certainly seen it with clients with UPS and the really big providers where there's a particular email address to just notify them that you're going to use it. There's no requirement for you to be authorised to use postponed VAT accounting. It's a question we get asked a lot, but you do need to log into your government gateway account to register, receive the monthly statements, and that's going to be your evidence to recover that import VAT on your VAT return. Other issues that we talked about and we found was a massive scramble towards the end of the year was to get a duty deferment account. So I suppose the question is, do you still need one? You know, if you're happy that you've got a nice free trade supply chain, you've not got import VAT because you've got postponed VAT accounting, you don't have duty, do you need one? If you do have one, let's look at those bank guarantee levels, because you can get them waived if you've got good compliance records, and if not, you can bring those down anyway. So I think certainly review that position, and also there are lots of different new forms in place from the 1st of January. Moving on, Incoterms. Really, they're back to they are the fundamental starting point for lots of things, for the VAT position, for who's going to be responsible for the declarations, having to get the agents, etc. Andrew, do you want to make any comments on what we're seeing with movements with agents?
Yeah, because obviously one of the big issues that we found was UK companies having to supply goods under DDP terms. Their customers didn't want any involvement in the customs formalities, so they were having to be set up with EORIs in the EU and VAT registrations. So that's one of the big issues. But we've also sort of started to see potential issues with representation of agents, with direct and indirect representation. So if you're not established in the EU, the agent is appointed as an indirect representative because they're jointly and severably liable. So we're starting to possibly see issues with that. So if you do have any concerns about getting your goods into the EU, or vice versa, getting the goods into the UK because you're not established there, then it's something that we can sort of discuss with you and help you out.
Yeah, and it's back to I think the Incoterms and the customs agents, that you have to get that right to be able to have any chance, don't you, of moving your goods across the borders. If we go to the next slide, it gives you, I think the next slide shows that who's responsible for what and who has what customs obligations. So if you're an exporter, you have to make the export declaration, you have to have a commercial invoice, you have to have the packing list. So the exporter, if you're a UK business exporting to the EU, these are all things that you have to get on top of. And the import, obviously the importer, and that costs money as well. So probably why a lot of people are also kicking back against it. They don't want the hassle of having to do that import declaration, but it's not as simple as just doing that declaration, as we'll see as we go on to the next, not the next area actually, sorry. Sorry, but we'll come to that with Jonathan and Marissa later on about VAT. But now, I'm afraid this is the really complex area that we all need to get to grips with, and it is very complex, and Andrew is going to take us through this maze about the origin of goods rules which underpin the free trade agreement. Over to you, Andrew.
Thank you, Alison. Okay, so if we move on. So, sort of important points to sort of consider. There will be no preference certificate issued for movement of goods between the UK and the EU. They've agreed to use two different types of evidence, so invoice declaration or importer's evidence. So I initially thought that there'd be a preference certificate because that's the standard process across all EU preference agreements, but because of the volume of the movements, it looks like they've agreed to make this as simplified as possible. So it'll be an invoice declaration on your your invoices that you send across the border. And there's no monetary limit on the invoice declarations at the moment. Whether that changes or not going forward, I'm not sure. But at the moment, there won't be any monetary limit. Full bilateral accumulation will be applied. So accumulation or bilateral accumulation was expected to be part of the trade deal. So it's an important point which we'll look at in a moment. And then we've got the requirement to retain the satisfactory evidence. So as the exporter of the goods, you would be required to retain the evidence to confirm the goods originate. So this is something that's additional that companies who manufacture goods or send goods across the border with a preference statement will need to have in place, which they might not have the facility to do at the moment. But it also, because we got the trade agreement with the EU, that then allowed for us to have a free trade agreement with Turkey, which was announced a couple of days afterwards. So there's some slight changes to the way we trade with Turkey compared to the current or the previous mechanism. And again, we'll talk about that in a moment. So if we move on. So the agreement allows for both UK and EU goods to be counted as inputs, and that's what we call bilateral accumulation. So where we've got goods purchased from Germany, for instance, that are going to be incorporated into a UK finished product, provided there's sufficient processing carried out, and they can be included as inputs for determining the origin of the goods for UK purposes. They can then be re-exported back into Europe as UK originating goods. So this was one of the things that a lot of the motor sectors wanted in place, because it allowed for all these different inputs within the UK and EU to be considered for originating purposes as part of the calculation for the finished product. So that's good news for a lot of the sectors within the UK and the EU. Okay, so if we move on. But it's the exporter's responsibility to confirm the origin. So if you're receiving those goods into the UK, for instance, it's not your responsibility. You've got the declaration on the invoice. It would be the exporter that has to confirm that. And as part of the trade deal, there is responsibilities on both parties to provide mutual assistance to monitor the evidence for origin purposes. If one country has an issue with it, they can send it for verification. But the origin is determined by the rules of origin, which are stated in Annex 2, I think, of the trade agreement. Okay, so if we move on to the next slide. To enable to determine origin, you need to firstly know what the first 6 digits of the tariff heading are for that particular product. If you don't know that, then you need to refer to the customs tariff, get the 6 digits, because in most cases it's 4 digits that's required, but there are certain circumstances where you'll need to go to the 6-digit heading to determine the rule of origin. So once you've got the 6-digit heading, you can go to the rule of origin in the trade agreement and identify what that is. So if we move on to the next slide. And that's where you can upload that trade agreement. So that's where it is. So there's 2 conditions that determine origin, and depending on which part of the tariff you're in or your goods are in, they could be one or the other. So there's wholly produced and sufficient production. So if we look at wholly produced first off, so this is where products are wholly produced or obtained within a member state. So it could be chickens or oranges that are grown or they're dug up from the ground. So they're naturally occurring in those particular countries. So they have to be wholly produced. So if we move on to the next one, I think it's got some example. So if we move on to sufficient production, so this is the chapters outside of sort of the food and agricultural sectors. So that rather than having to be wholly produced, they have to be sufficiently produced, or there has to be some sufficient transformation to the raw materials to qualify. And that's usually where the finished product is classified in a different 4-digit tariff heading to the actual component. But there are some exceptions where the rules of origin set a maximum limit of non-originating materials or there has to be a certain qualifying process to be carried out. So if we look at the next slide, certain processes are considered to be minimal, and this is an example. There's a lot longer list which is detailed in the trade agreement, but it gives you a sort of a flavour of the different types of processes. So just preserving those goods or keeping them in a good condition during the transport. If you're just breaking them up into smaller packages, you're not changing the format of those goods, you're just reboxing them. If you're just washing or cleaning or ironing, that's, again, it's not changing the goods in any way, it's just preserving them or making them into a better format, and simple painting and polishing, etc. So if it's not changing the structure of that particular product, then it's not classed as sufficient production. Okay, so if we take this as an example, so if you're a UK company manufacturing fruit smoothies, the commodity code for a fruit smoothie is 2009. So that's the first 4 digits. So the origin rule for this is where it says CTH, it means change of tariff heading. So what that means is it has to change the first 4 digits. So if you're importing basically a smoothie, and all you're doing is perhaps adding some sugar in or adding a little bit more fruit, then it's not going to change its tariff heading. So therefore it wouldn't qualify. It has to change tariff heading. But if you're sourcing raw materials such as the fruits, etc., they would fall under Chapter 8. They're going to be sufficiently processed, so mixed up together, crushed, etc., to make this smoothie, and therefore the finished product would be classified as 2009. So that's what change of tariff heading means. So for this particular rule, you could import fruit from Europe under bilateral accumulation. You could import those fruits from Europe, and they could be included into the UK origin because they're changing the tariff heading and it's part of the trade agreement. So those goods can then be re-exported or exported into Europe, classed as a UK originating product. The only issue with this one is that the sugar content, because it's Chapter 17, cannot exceed 40%. So if you're importing large volumes of sugar from outside the EU, if more than 40% by weight of that product contains non-originating sugar, then it wouldn't qualify. So there are certain circumstances within the rules of origin that could trip you up in that respect. But for this particular one, provided all those parameters are met, those goods can be classed as a UK originating product. So if we move on to the next one, if we're looking at a sort of an electric or hybrid motor vehicle, where they fall under Chapters 87 to 8702 to 8704, in this particular one, this relates to a maximum amount of a non-originating material. So where it shows max non, that's maximum non-originating material. So where you've got an X works price of, say for instance, £100, provided less than £45 of that X works price is made up of non-originating materials, then it would qualify. With this particular rule of origin, it adds in that the battery packs have to be of originating nature. So with the bilateral accumulation, they could be from the EU, incorporated into a UK manufactured vehicle, and then exported back into the EU. So that's where accumulation comes in. So it might meet the 45%, but now because you're sourcing those in from the EU, it would qualify because they're part of the accumulation agreement. Okay, so if we move on to the next one. So in terms of evidence of origin, there's 2 options. So there's a statement of origin by the exporter. So at the bottom, you've got the statement. That's the standard statement that's on all trade agreements. So you probably, if you're exporting to countries such as Switzerland or Norway, and you're using an invoice declaration, it's the same format. There are 2 differences with this one. So if you're a UK exporter, you'll just need to put your EORI number in where it says exporter reference number. At the moment, there's no facility for UK exporters to have to register to be able to do this process. But for EU exporters, they will need to be registered for REX. So that's an EU system which the UK used to use, but now we're outside the EU, we obviously don't do that at the moment. But for EU exporters, they will need to register for REX, and that exporter reference number will be their REX number. So it's slightly different for EU exporters, and obviously they need to register for that situation. The other option for evidence is importer's knowledge. So the importer can claim the preferential duty rate based upon their own knowledge. So this might apply if you're shipping under DDP terms. So you're the importer, you're claiming the preference. You would have knowledge of how that product was built up for the rule of origin. So you'd perhaps be able to use the importer's knowledge rather than the statement of origin. So they're the two different mechanisms for the evidence of origin. So there's no preference certificate. It's just using one of those two. But I would expect that in most cases, it will be a statement of origin on an export or commercial invoice or packing list. So when we talk about accumulation, again, you can have UK origin parts being exported to the EU for processing, provided that they'd have sufficient processing or they meet the rules of origin. Those finished products can then be classified as EU origin and then been brought back into the UK under a preference statement. So a statement of origin on that commercial invoice would show EU origin, and there'd be no duty. So there would be no duty between the export and the import, because the original export into the EU would have a statement of origin as well, saying that they're UK origin parts. So this allows for the reduction in any customs duties crossing borders where they're UK and EU products. Okay. So with full bilateral accumulation, that allows for an exporter to use both originating materials and products, and processing and production carried out of non-originating materials. So where we're looking at change of tariff heading, that includes non-originating materials as well. So even if an EU intermediate product is not deemed as originating from the EU, UK firms can count the EU value added in that product when using the import in the final good, and that's all shown on sort of suppliers' declarations and things like that. But all operations carried out in the UK or EU are taken into account when determining origin. So they're again, but they have to meet they must be sufficiently processed. So if they don't meet the insufficient processing part, which is in the Origin 7 article, then they're not sufficiently processed. Okay. So if we take this as an example, so we've got a tin of chopped tomatoes. So the tomatoes are processed in the UK. So in this particular instance, it goes to the 6-digit tariff code, so 200290. So for the origin rule for this one is production in which all the materials of Chapter 7 used are wholly obtained. So Chapter 7 is the tomatoes, and they have to be wholly obtained. So under accumulation, the UK company can import EU tomatoes and process them in the UK to meet that rule of origin. And that's again, by having bilateral accumulation, it allows for that. We don't have to have the tomatoes obtained in the UK. They can be brought in from the EU, processed sufficiently, and then that changes the tariff heading to the 2002, and they can be exported as a finished product as UK origin. With this particular one, with a diesel engine, with a HS code of 8408, this has a quite simple rule, so it's 50% max nom. So 50%, a maximum of 50% of the ex-works price can be made up of non-originating materials. So you can have components from all over the world incorporated into this thing. Obviously, the EU materials will be classified as the UK origin calculation, but the non-EU components, provided there's less than 50%, it will mean it qualifies as UK origin. One of the things to consider is tolerances. So if you've got a rule of origin that means that it has to be wholly produced, there are tolerances that are available. So for agri-food products, there's a 15% by weight. So you might have a small part of that finished product that you have to source from outside the UK or EU. Provided it's less than 15% by weight, it can be included and that won't affect the rule of origin. So that's where these tolerances coming in. And then for manufactured goods, it's a 10% by value. There are certain differences with clothing and textiles, and they're specified separately within the trade agreement. But if you're importing goods for a finished product and you've got to do a certain process, but it doesn't qualify for that, then the 10% rule can be used to sort of gain UK origin. So tolerances could be quite an important factor when looking at rules of origin, because you might not meet the rule of origin, but if you can factor in tolerances, that might be enough to be able to sway it to UK origin. So if we take this as an example, we've got mixtures of dried fruits and nuts produced in the UK. So we've got a commodity code of 081350. So for this one, the production says all materials of Chapter 8 used are wholly obtained. So this requires the nuts and fruit to be grown in the UK. But with the tolerance rule, you can have 15% of the net weight of non-originating fruits. So you could bring in the nuts or fruits from outside the UK or EU, provided it's less than 15%, it would still meet that part of that rule of origin. So that's where tolerance comes in. And as I say, it could be an important factor when you just need to source one particular part of that finished product, which can't be used or cannot be classed as wholly obtained. So in terms of evidence of origin, if they're wholly produced goods, you'd need to have a statement of where they've been grown or reared. For fish, the vessel has to be registered in the beneficiary country and is sailing under its flag or an EU member state. With sufficient transformation, that would tend to be bill of materials or production records, supported by a supplier's declaration if required. So if we look at a 50% max non rule, for instance, if you've got parts and components that are less than 50% and the rest of that value is made up of profit, labour, manufacturing costs, then you're not really going to need a supplier's declaration. It's only where you're exceeding that 50%, you're going to need supplier's declaration to evidence that, because that's something that HMRC will look at. They will try and work out what parts of that, which components are UK origin or not. So if you've not got a supplier's declaration and you need to have one, that's something that you need to get put in place. There is a transitional period at the moment whereby if you use existing suppliers, you don't necessarily need to have that from day one, but it's something that HMRC will be looking at going forward. And I expect there'll be quite a lot of activity in terms of mutual assistance to get things up and running and get everything evidenced properly. So you could find that your company is visited by HMRC to check origin in the medium term, just to make sure you're doing things correctly. So when we talk about a supplier's declaration, there's two types of supplier's declaration. There's a single declaration which covers just one consignment. So you might just have an annual supply from a particular supplier. You can just have a single declaration. But generally, we look at a long-term declaration which covers a period of up to about 12 months, which can be backdated. And this is the standard format that we see on the screen for the long-term supplier's declaration. And this is including things like non-originating materials if required. So this is the document that you need to potentially get from your suppliers if you need to get that in place, so that it's evidence that HMRC have got just in case they audit. But this is the sort of backup information that is going to be required by companies who are shipping goods out under cover of a preference statement.
Andrew, thank you very, very much for that. It is an absolute maze. What comes across very clearly is that getting to grips with that tariff and all the additional notes and identifying where your goods go is so very, very important to start to get on top of the rules of origin. And it's interesting to see as well about the fact that you can have non-EU goods that are included in your finished processed product, but you need to navigate some pretty complex rules to get there. And obviously that evidence point, it's something that, as you say, people are going to have to get to grips with over the next few months, because I'm imagining that once we're some way into the year, if those evidence certificates or the statements are not correctly documented, will that mean a problem at importation?
Yeah, because obviously with mutual assistance, what will happen is, say for instance, a shipment of UK goods went into Germany. The German customs authorities could check that statement and say, well, we want to verify that. So they can arrange for that invoice to be sent back to the UK, and HMRC would have to verify whether the UK exporter has the sufficient evidence to confirm those goods are UK origin. So that's what I think is going to happen at some point, because the EU are going to want to monitor this. So you could get a visit from HMRC saying, look, you've exported these goods, here's a copy of the invoice, what evidence have you got to confirm that they meet the rule of origin? And if you haven't got the backup information, then HMRC have to inform the German authorities, and that would mean the German customer would have to pay the full rate of customs duty. So that's why it's so important. It doesn't have a duty impact on you as the exporter, but it could in the long term affect your business with that customer because you're supplying goods incorrectly.
And I guess if you don't have that statement on your documentation, then the German customer is going to be charged duty because we've not met those rules of origin.
Exactly. So, yeah, that's the prime statement that needs to be put on the invoices to confirm that the goods originate. But you still need to at least know that you've met the rule of origin. So it's making sure you know the commodity code, you check the rule of origin, and if you're happy with that, then you've got the supporting evidence, then everything should be okay.
So make sure you make that declaration. And of course, the New Year challenge to everybody is to be able to use bilateral cumulation in a sentence sometime in January. So yeah, let's move on then to the UK-Turkey trade agreement. Thanks, Andrew.
Okay, yeah, so within a couple of days of the EU announcement being made, the UK-Turkey agreement was announced as well. So it mirrors, in a lot of instances, the EU-UK agreement, whereby there won't be a requirement for an ATR1. Again, it's a statement on the invoice only, which is a major change. So companies that are receiving goods in from Turkey from the 1st of January, there shouldn't be an ATR1 certificate. If you've got goods that are held in a customs warehouse at the moment, then the ATR can be declared when you remove them from the warehouse, but there shouldn't be any requirement for that certificate from now on. The previous agreement that the EU, or the agreement that the EU and the Turkey had, was basically that goods in free circulation didn't require payment of customs duties when they came from Turkey into the EU. That's changed now because we are outside the EU, so there are rules of origin in the Turkish agreement which must be met to be able to move those goods under a preference statement. So it's, again, looking at that Turkish agreement, seeing whether, if you're exporting goods to Turkey, do your goods meet the rule of origin, so you can send that consignment under an invoice statement. So that's a slight change. So again, it's looking at the agreement. What do you supply? What is the commodity code? Again, cumulation applies to manufactured goods, and it's not just from the EU. It applies to a number of different countries, and they're set out in Annex 4 of the agreement. There's a long list, which I wouldn't want to bore you with on here. But if you go into the agreement, if you think you're purchasing goods from those particular countries, you can use that in the accumulation, so you can count that as UK origin when you export them into Turkey. So in terms of bedtime reading, the full text for the European agreement is on the link there. There's also there's a guidance document which HMRC issued sort of between Christmas and New Year that gives a lot more detail on how to confirm origin and sort of examples of origin calculations, etc. And then you've got the full UK-Turkey free trade agreement as well, which has been published on the .gov website. So I say if you deal with any of those, it's worth looking at just to check your the rules of origin for the goods that you trade with.
Thanks, Andrew. I think we're going on to our last slide now on the customs side, which is dealing with the customs regimes. You know, we've talked about these a lot in the past. You know, are they still important in the light of a free trade agreement. I certainly think for customs warehousing, if you're importing into the UK from outside Europe, from the rest of the world, then, and they don't meet the origin rules, then I think, Andrew, you would say that yes, they are still very important.
Oh yeah, certainly, yeah. If you're bringing in finished goods from outside the EU, say for instance from China, and all you're going to do is onwardly supply them into the European market, then customs warehouse is going to be important. Otherwise, you're going to have to pay customs duty twice. Obviously, again, it's looking at the commodity code, because obviously the UK tariff is different to the EU tariff. But if you've got goods that have got a positive duty rate on import into the UK, they will have a positive rate into the EU. So if you're in that situation, then customs warehousing will mitigate the requirement to pay or be liable for the customs duty twice. So yeah, you don't need to have your own customs warehouse. You can use a third-party warehouse. But if you're in that position, then yeah, customs warehousing is the only way you can minimise your duty liability.
And what about inward processing relief? Because I know that's used an awful lot certainly in the manufacturing and motor sector. Is that still as valid and valuable?
It's the thing is, with inward processing, you can't use inward processing and preference at the same time. So if you're bringing in goods that but the finished product you want to classify as UK origin, say for instance all your sales go into Europe and it's a positive duty rate into Europe, you're probably going to want to use UK origin. So it's a balance between, well, do we want to import and pay the full duty rate and incur it as a non-originating material because it's a lesser duty rate going into Europe, or use inward processing so that we minimise our duty impact coming into the UK, but there'll be a positive rate going into Europe or not when it's re-exported. So it's, for processing purposes, it's looking at what you're bringing in, where you're selling it to, and establishing, well, which one's more beneficial, origin or inward processing. But yeah, if you're bringing in goods for manufacturing and you're shipping all over the world, then inward processing would be the way to minimise that liability for customs duty. So if you're bringing in goods from Europe but you're exporting to the US, then inward processing would be something you would need to have in place.
So a very important consideration for businesses using inward processing.
Mm-hmm.
Couple of final points from Andrew and myself are customs freight simplified procedures. That's where people do their own customs declarations, lots of software about, got to get authorised, and still very useful for businesses who have large volumes of transactions. I think you would agree, Andrew.
Yeah, we've seen some uptake on doing own declarations with companies that probably make 500-600 declarations per year. When you compare that with being charged £45-50 per declaration, it makes sense for them to do it. Obviously, you need to be approved by HMRC. A lot of the software requires you to have this CFSP authorization, but there are also online systems where you're not requiring CFSP, but you're putting the information in, and that software provider is approved for it. So there are different ways and means, but we have seen an uptake on companies looking at sort of in the next five or 6 months to try and do their own declarations because of the cost saving.
Thank you. One final point, AEO, Authorised Economic Operator, it has been announced that the UK regime will have mutual recognition with the European Union and the USA, so that's really good news. So that's us on the customs side. Let me now hand over to Marissa and Jonathan to talk about VAT.
Thank you very much, Alison. I will start with the EU side of things with this B2B trade in goods slide. When goods are coming from Great Britain, now, as of January 1st, 2021, of course, goods must be exported out of the UK, as we just heard. And if the goods are shipped, let's say, for example, from GB to the Netherlands, the goods must be exported out of GB. The first question that comes up is, who is responsible for that export out of GB? Is that the supplier of the goods, or is that the customer of the goods? It can be both. If the supplier exports the goods out of GB, of course, that can be done. But then the goods arrive, in this example, in the Netherlands. When the goods arrive in the Netherlands, the goods must be customs cleared in principle. And then the second question that comes up is, who is responsible for the customs clearance of the goods into the Netherlands? Is that the supplier, or is that the customer? Because if the supplier and the customer agreed on an Incoterm such as DDP, the supplier in GB is responsible for the customs clearance in the Netherlands. Of course, that can be done. That's no problem at all. But the supplier must make sure that it complies with multiple rules. The first thing that it will need is an EORI number in an EU country, let's say a Dutch EORI number. It can easily apply for that through Dutch customs. Once it has an EORI number, the goods can be customs cleared. When the goods are customs cleared, import VAT and import duties could be due. If import duties are due, these are always a cost, so these are not refundable. You must take this into account. Import VAT will also be due, but import VAT is reclaimable, and it can be reclaimed through your VAT return. However, in order to eliminate that cash flow disadvantage of paying import VAT to the tax authorities and reclaiming it afterwards, the GB company could also apply for the import VAT deferment license in the Netherlands. What does that license do? Well, at the moment of import, no import VAT is due. The import VAT must be reported in the VAT return. In the same VAT return, it can be reclaimed. So on balance, no import VAT must be pre-financed. However, a company not established in the Netherlands can only apply for an import VAT deferment license if it's appointing a fiscal rep in the Netherlands. Once the goods are customs cleared in the Netherlands, the goods can be stored, but they can also be shipped directly to the customers. These can be customers, of course, in the Netherlands, but it could also be customers in other EU countries like France or Spain or Italy or Germany. These sales of goods must be reported by the GB company in the Netherlands in its Dutch VAT return. So it must also have a Dutch VAT registration, and it must file Dutch VAT returns on a frequent basis. The standard reporting period in the Netherlands is a quarter. There's one big misunderstanding, which we have heard many, many times in all Brexit preparations and are still hearing, is that there is absolutely no need for VAT and customs to set up a legal entity in the EU if you want to import and sell the goods onwards, or if you want to have stock. Keep that in mind. Jonathan, if we now move to the next slide and to the situation whereby the goods are shipped from the EU to GB, what are the consequences?
Thank you, Marissa. Good morning, everyone. One of the points I'll make first of all is you'll notice on the slides that Marissa and I are going through that a few of them will refer to the EU and GB, Great Britain, whereas a few that are coming up shortly where they relate to services talk about the EU and the UK. The difference is important because, as I mentioned in a number of presentations I did running up to 31 December, Northern Ireland is in both the EU and the UK, depending on what it's doing, trading in goods or trading in services. And we're blessed to have Angela Keary with us from Baker Tilly Mooney Moore in Belfast, as she will be covering the way in which Northern Ireland differs from the rest of the UK. But just to make the point that that's why this slide, talking about products coming into the UK, is limited to Great Britain, because the rules for products going into Northern Ireland are different. You're importing goods into the UK, and effectively a mirror image of what Marissa ran through. One of the questions to deal with is who is importing? Well, probably before that, and linked to it, who is exporting? You'll be buying from your supplier in France on that slide. Is that being sold to you ex-works, or delivered at place, or delivered duty paid? Those Incoterms matter, as previously mentioned, but worth reinforcing, because it fundamentally affects who then completes the importation obligations into the UK. But let's assume it's ex-works and run through that. You will then be the importer into the UK, so big change number one from pre and post December. That now requires import entry to be completed. As Alison and Andrew mentioned earlier, make sure your freight forwarder, if that's who's going to be your customs agent, understands the way in which the import entry should be completed, because not all of them do, to make sure that you don't have to pay the VAT at import. I won't go back over all of the origin rules that Andrew very helpfully went through, but obviously that's a key part of this too, in understanding what the goods are, what their origin status is, and whether or not any duty is payable. Bear in mind, of course, that even if origin status isn't there, it may be that the goods you're bringing in aren't dutiable, because a lot of goods aren't. And as Andrew mentioned, also quite a lot of tariff have been removed on items that had a rate of 2% and below. So all of that is worth going through. If your supplier is selling to you DDP, so deliver duty paid, then sort of getting onto the lower half of those bullet points, that means they're the importer of record. That means they're supplying the goods to you in the UK, and it will mean that they'll need to register for VAT in the UK. And as Marissa said on the previous slide, that doesn't mean there's a requirement for them to have a legal entity in the UK. But it does mean they are supplying the goods to you on that basis. My experience with talking to clients in the run-up to and since the new year has been that very few suppliers at the moment are selling DDP into the UK. It seems to be ex-works as a matter of routine. Final point to mention, and this I'll cover in more detail, as will Marissa for the other way around. There are new rules coming in, or coming now, I should say, from the 1st of January for sales, e-commerce sales via a website or via an online marketplace. And if you're buying goods that are less than £135 in value per consignment, so not per item. So if there are several items of £50 each in a consignment that takes that value over 135, this wouldn't apply. So for a consignment of £135 or less, there is no import duty or VAT. And instead you perform something called a reverse charge on your UK VAT return to deal with the VAT requirements. I mentioned that for the sake of completeness. I'm guessing that in most cases, consignments are going to exceed that level. It will, however, be more important when we get on to, rather than B2B transactions, B2C transactions on the next couple of slides. So back to you, Marissa.
Thank you very much, Jonathan. If you could go to the next slide, that would be very helpful. Yes, here are the B2C sales whereby goods are moving from an online shop in the UK to GB, I should say, of course, from Great Britain to the EU. So an online shop established in the UK is selling goods to consumers in the EU. Of course, we still have then the same questions. Goods must be exported, but goods must also be imported into the EU. The question is, who is responsible for those imports into the EU? Who is going to pay the import duties and who's going to pay the import VAT, if due? Is that the online shop? Are they going to all arrange that for their customers? Or will the consumers be confronted with a bill afterwards whereby they are being charged with these import duties and import VAT? Of course, you do not want to surprise your consumer customers because you want them to return to your web shop at some point. So you have to make sure that your website is clear. What are the conditions? Who will be responsible? Are the prices including already the possible import VAT and import duties or not? In addition to this, be aware that as of July 1st, 2021, the EU is also going to change its e-commerce regulation drastically, like the UK already did now. Be aware of these changes. Jonathan, how does it look like when an EU web shop is now selling goods to consumers?
Thank you, Marissa. So As I said a minute or two ago, these rules have just come in. There are different rules depending on whether you're selling on your own site or selling through an online marketplace or Amazon or eBay, for example. I'm finding that most of my clients in this space sell both ways. So you have the added complication. So last year, when we were in the transition period and still in a customs union, we were covered by the distance selling regime, which means you sell goods cross-border within the customs union and are responsible for their delivery, which is obviously commonly the case. Those rules no longer apply because we're not in the transition period anymore. We're a third country. So goods coming into the UK would, if it weren't for these changes, be an import with import duty and VAT depending on their value. That is not the way things now work from the 1st of January. So if you are a French supplier selling into the UK on your own website and are responsible for delivery, and the goods are below £135 in value, so if you've got to that point, then there is no import VAT. £135 or €150, by the way, is relevant because that's the value above which duty does apply to shipments of goods. So there's no VAT at import. Instead, as the French supplier, you are required to register for UK VAT and charge VAT on your supplies in the UK, or rather your supplies to the UK. The purpose of this is nothing really to do with the EU at all. The purpose is a long-standing desire for the EU in general, and including the UK when we were a member, to deal with lost VAT on supplies by non-resident businesses throughout the EU, so pick China, the US, the Far East, wherever, and require those businesses to register in the UK, or in fact in the EU, as Marissa said, from the 1st of July. Moving on to goods being sold via an online marketplace, because my instinct is that's the more common way in which foreign suppliers will access the UK market. Rather than you having to register for VAT, the VAT is dealt with through the online marketplace, meaning they account for the VAT on their VAT return. So Amazon would account for the VAT on its VAT return and obviously deduct that and its commission from the amount that you get as the actual supplier. So they're the rules if the goods are outside the UK at the time of sale. If, however, and again, this is going to be quite common, the goods are sitting in an Amazon warehouse in the UK at the point at which they're sold to the customer in the UK, then those goods will have been imported and not yet sold to a final consumer. So there will be import VAT, which you will need to, as the overseas supplier, recover by registering for VAT. There is then a mechanism to facilitate that happening that requires you as the overseas supplier to, that's the best way of putting it, declare the sales on your UK return as though they were subject to VAT at the 0 rate. Doing that allows you to recover the import VAT, and Amazon then accounts for the VAT on the sale as though it were making the sale, where in reality, of course, it isn't, because probably it's just acting as the fulfillment arm for you. And again, it would deduct the VAT and its commission from the amount it then passes across to you. I suppose the fourth alternative in all of this is the goods are in the UK, not being sold via an online marketplace, being sold via your own website. In that situation, I suppose the punchline is you should already have been registered for VAT if you're a non-established taxable person. Again, nothing to do with Brexit. and those supplies would already have been subject to UK VAT, which would have been your responsibility. So a lot to take on board in terms of the changes. And just to cover off the final part of this slide, if the goods are over £135 in value, none of what I've just said covers your situation. And those goods remain imports, remain subject to duty and VAT potentially, depending on where they're coming from and what they are. And I suppose if you've got goods which straddle that value, then you've got every possible complexity to deal with, unfortunately. Which leads to the final point, which is just the need to make sure that website pricing is correct. And of course, just to wrap up, this isn't just non-UK based businesses. I can think of two of my clients that sell in this way from manufacturing plants in the Far East. So it is a UK business, but the goods are being sold traditionally to customers from, in one case, the Philippines. So you need to work through this. You need to understand how it's going to affect your business. I guess back to you, Marissa, I think at this point, is it?
Yes, correct. We are going to talk about services. Everything up until now was, of course, about goods, because Brexit has most impact on the supplies of goods. But, of course, we also have services in VAT legislation. If we are talking about B2B main rule services, yes, there are going to be changes, but these are often minimized to changes in the way these are being reported. However, if you are providing e-services, so electronic services to consumers, you have to be aware of additional changes. And what are e-services? Well, if you are, for example, selling online books, or if you are selling online games, these services are subject to VAT, so taxable for VAT in the country where that consumer, where your customer is living. So if a UK established business, or a UK established business in this situation, is providing electronic services to consumers in the EU, these services are subject to VAT in all these EU countries where the consumers are living. So VAT is due by the UK company in all these EU countries. Until January 1st, 2021, there was this beautiful system in place, which is called MOS. UK companies could register for MOS in the UK. They would pay the VAT due in all the EU countries through HMRC. HMRC would pay it to all the EU countries. However, as of January 1st, 2021, the MOS system is no longer available for UK companies. So what does that mean? A UK company who is providing e-services to consumers in the EU needs to register for MOS in an EU country. This can be done, but must be done as soon as possible, because the MOS system only has a very limited retrospective effect. If you are not registering on time, you must register for VAT in all EU countries and file local VAT returns in order to report the VAT due. So if you are providing e-services to consumers in the EU as a UK company, make sure that you register for MOS in an EU country as soon as possible. Jonathan, how does it work when an EU company is now providing e-services to consumers in the UK?
Yeah, thank you, Marissa. And just to make the point again, we're now talking about the UK because Northern Ireland is not in the EU when it comes to services. So this applies throughout the UK. So very much the same. The UK is not in the transition period, not in a customs union. So any supplies that would have been dealt with by a MOS registration no longer can be, because the UK is now disconnected from that system. If you are supplying these services from outside the UK to private individuals within the UK, then you will need to register for VAT because the place of consumption is here. And that is going to be a requirement quite simply from the 1st of January for any transactions from that point. The final MOS return for 31 December would cover any transactions up to that point. So that's, I suppose, in simple terms, the position. I think it's still me. So again, We're back to GB as opposed to UK because these are rules in relation to goods that no longer apply here because we're not in a customs union. Triangulation. So this is a situation, one of my clients at the moment, we're dealing with this, where goods are shipped from Greece to Germany, but sold via a UK company, with delivery happening directly from Greece to Germany. And we understand that the Greek supplier is sending the goods DDP, the food products. That would have been a triangular transaction, which under the simplification measures in place would have allowed that to happen without the need for the UK business buying and selling to register anywhere within either Greece or Germany. That's no longer the case, and that UK intermediary will have to register, most likely, and certainly in the scenario I've outlined, in Germany, because it's taken delivery of goods there that it is then selling to its German customer. Call-off stock simplification, similarly, having call-off stock sitting in a particular EU country while we were still in the customs union would not have given rise to a liability to register for VAT when that stock was called off. That's no longer the case. Again, installation of goods, another one, would have allowed EU or UK GB suppliers in either direction to not register in the territory in which the goods are installed. That's gone. I've already mentioned distance selling and the changes that are happening there. And refund claims. So we've got until the 31st of March to either UK companies to file claims for recovery of EU VAT or vice versa, EU companies to file claims to recover UK VAT for any VAT incurred up to 31 December. The good news, I guess, is that the regime is not disappearing. It's changing in nature because, as we've said up throughout, we're now a third country, so the process is slightly different in as much as UK businesses need to check the procedure individually in each EU country to determine what VAT they can recover, which was largely what needed to be done anyway because the rules do differ. EU businesses will be allowed to recover UK VAT unless, and I assume this isn't going to be the case, any specific EU country which had a regime allowing for VAT to be refunded discriminated specifically against the UK. So I'm guessing that will mean that EU businesses will continue to be able to recover UK VAT under the deadlines that apply to actually, no, I'm tripping myself up. The deadline that applies to all non-UK businesses, or non-GB, but non-UK businesses. This is a UK, not a GB-wide situation. With that, I'm going to hand over to Angela.
Hi. So, good morning. So, thank you, Jonathan, for that. There's been a lot of really useful information to date. I'm going to talk about Northern Ireland in particular, talk about the Northern Ireland Protocol and how it is affecting trade from the 1st of January. Hopefully, everyone will, by this stage, be aware of the Northern Ireland Protocol. The Northern Ireland Protocol was brought in as part of the withdrawal agreement in October 2019, and it's designed to protect the Good Friday Agreement. So, it's designed to protect free trade on the island of Ireland. What the protocol says at a really high level is that Northern Ireland will benefit from any UK trade deals. However, Northern Ireland will remain part of the EU single market and will follow EU regulations on goods whilst remaining part of the UK. So Northern Ireland is in this unique position where it's effectively got two custom systems to deal with. So we're going to have a look at how that impacts, first of all, trade from Great Britain to Northern Ireland. Can I get that slide, please? Thank you. So the first point there on goods going from Great Britain to Northern Ireland is that there will be physical checks and export health checks required on food and agricultural products, sanitary and psychosanitary products. Those checks have been delayed for a period of 3 to 6 months for certain authorised traders only. And they are certainly one of the big issues that we're seeing, and one of the big reasons why certain GB businesses have difficulty and are at present not wanting to trade with Northern Ireland going forward. So if you're in that sector, that's just something to be aware of. The main issue is that the UK authorities have to apply EU customs rules to goods entering Northern Ireland that are likely to move to the EU. So in effect, what that means is that a customs declaration is required for all goods moving from Great Britain to Northern Ireland. So that is a new process for traders. It's a new electronic import declaration, the customs declaration, and a safety and security declaration. Businesses that are trading with NI or NI trading with any non-EU business from the 1st of January 2021 require an XI EOI number. So we've already heard Andrew and Jonathan talk about the need for an EU EOI number, the need for an EU EOI number if you're exporting to the EU. If you're going to trade with NI, you need an XI EOI number. If you don't have one, it's relatively easy to get. If you have your if you have your UK EOI number, you can go online and request an XI EOI number. So that's the first step. Once you have your XI EOI number, the next step is to think about how we're going to complete the customs declarations. And the good news is that unlike trading with the EU, businesses in GB do not need to engage a customs agent for this. The Trader Support Service is a free service that has been set up by the government. The government are going to fund it for a period, hopefully of 2 years, and they will complete all of the customs declarations on your behalf. But you do need to have registered with them in advance. They need details of your business, of the products that you're bringing into Northern Ireland, and of the commodity codes relating to those products. If they have that information in advance, they should be able to complete all of the declarations on your behalf. And that's a massive benefit to both the Northern Ireland business and the GB business, because Andrew talked about Incoterms earlier on, so it's quite often the GB business that will be delivering them to the business in Northern Ireland. So therefore, it is the GB business that will have the requirement to have registered for the Trader Support Service and the requirement to complete those customs declarations. Can I go to the next slide, please? So once we have got our XI EOI number to enable trade between NI and GB, and we've registered for the Trader Support Service so that they can complete the declarations on our behalf, the next stage is to think about tariffs. So we know that with the free trade agreement in place, thankfully, there are no tariffs on goods moving between the EU and the UK, where they are EU or UK originating goods, as Andrew has explained so well. In addition to that, the Northern Ireland Protocol says that there should be no tariffs on any goods moving from GB to NI unless those goods are at risk of moving into the EU. And that phrase is very important, at risk of moving into the EU. So if we think about, take an example of a business in Bristol, for example, that is exporting goods to Northern Ireland, but those goods happen to come from China. So those goods would not qualify for zero tariffs under the trade agreement. However, if those goods are going to be used by final end users or consumed within Northern Ireland or the UK, there should be no tariffs on those goods. And there should be no tariffs on those goods because the person who is responsible for the declarations should be able to declare them as being not at risk of moving to the EU. And the way that they do that, the way they are able to declare them as being not at risk of moving to the EU, is to register under the UK Trader Scheme. So get your XI EOI number, register under the UK Trader Scheme, register for TSS and then register under the UK Trading Scheme. And that means they only pay tariff on at-risk goods, which are effectively goods that do not originate within the UK or the EU, and which are going to move into the EU, which are going to be sold on to Ireland, for example. If at that point there is still a tariff that's due, you can claim a waiver of the tariff that's due purely on goods moving from GB to NI. And you can claim that tariff waiver up to the amount of de minimis aid. And that de minimis aid is £200,000 over 3 years. That de minimis aid has to include all the minimis aid that you receive. So, for example, the employment allowance would be part of that. But we think that in practice, it means very few businesses or very few goods that move from GB to NI, there will actually be a tariff on. The government have given us statistics for around 2%, and that remains to be seen. Finally, just to finish off on goods moving from Great Britain to Northern Ireland, there's been a lot of press around sending parcels from GB to NI. So where the parcel coming from GB to NI is going to a business, and the value of that parcel is £135 or more. So they've picked that £135 limit for various things. Where the value is going to a business in Northern Ireland and it's worth £135 or more, the business in Northern Ireland that receives the parcel has the obligation to complete the customs declaration. They have been given a deferral of 3 months to be able to complete that customs declaration, and again TSS will do it on their behalf. But I would strongly recommend any businesses in Northern Ireland, even if they don't normally think they're bringing in goods from GB or that's not part of their supply chain traditionally, to have an XI number and to register with TSS, so that if they order any parcels from GB, then they'll be in a position to ask TSS to complete those declarations on their behalf. If the parcels are less, coming from a GB to NI to a business, and they're valued at less than £135, then there are no requirements, and indeed if they're coming to an individual, there are no customs requirements either on the individual in NI or the business in GB. Can we move on to the next slide? Thank you. So the next stage then I think is to look at goods going from Northern Ireland to GB, so going the opposite way around. There are no customs declarations required on goods going from Northern Ireland to GB. The Northern Ireland Protocol stated that exit declarations would be required, however that seems to have been relaxed to the point where no exit declarations are now required on any goods moving from Northern Ireland to GB, unless there are for example, the goods are in a certain customs procedure or they're subject to certain specific processes. Very few goods will require any documentation going from NI to GB. And the reason behind that is that goods from Northern Ireland should have, under the Northern Ireland Protocol, should have unfettered access to GB. And the language that they talked about was whether that was Northern Ireland goods or Northern Ireland businesses should have unfettered access. The definition at the minute talks about this unfettered access and no exit declarations required for qualifying Northern Ireland goods. And the definition of qualifying Northern Ireland goods are simply goods that are in free circulation within Northern Ireland, so it's not subject to any other customs processes. That's a very wide definition, and if you can imagine, there's the potential for Northern Ireland to be used as a backdoor into UK if the EU decided to route their goods through Northern Ireland and then on into the UK without having to complete an exit declarations or any of the customs formalities. The government have said that throughout 2021 they're going to put in a longer term definition of the qualifying trades, qualifying businesses, with the view that really it should only be Northern Ireland established businesses that are able to send goods without an exit declaration from Northern Ireland into Great Britain. And indeed they have said that they will bring in anti-avoidance legislation where it becomes clear that those EU goods are being routed through Northern Ireland to avoid UK customs procedures. The issue is, of course, how will they be able to spot them without the exit declarations in the first place? On Northern Ireland to EU, so Northern Ireland for goods, we are still part of the EU single market. There's no paperwork, no tariffs, no quotas, no checks on goods moving from Northern Ireland to the EU and vice versa. So no EU member state will be able to apply any tariff or related barriers to goods from Northern Ireland. And that's a point that really needs to be emphasised within the EU. I think Northern Ireland businesses, because of the Northern Ireland Protocol, are very aware of it, but many EU businesses haven't picked up the distinction between Northern Ireland and Great Britain at this point, and the fact that they will be able to move goods without those customs requirements. Northern Ireland and the rest of the world, there will be import tariffs when goods come into Northern Ireland from the rest of the world, and the tariff that is applicable will depend on whether that product is at risk. So at risk are the goods that are at risk of moving into the EU. So a product coming into Northern Ireland where we know it's going to be sold on to Ireland, for example, will be deemed at risk, and the EU common tariff would need to be applied to the goods at that point. If we know that it's staying in Northern Ireland or within the UK, going to be finally consumed within the UK and Northern Ireland, you'd be able to apply under the UK trader scheme to declare those goods not at risk, and you will pay the UK tariff for those goods coming in. I should say, actually, at this point, GB businesses can apply under the UK trader scheme to declare goods not at risk. The UK trader scheme to declare goods not at risk is normally is mainly designed for Northern Ireland businesses who know where the goods are going to. But if a GB business is sending goods to Northern Ireland that are of non-UK or EU origin, on which they would be allowed to pay a tariff, but they can say that the Northern Ireland business is going to use them for final consumption within Northern Ireland or the UK, then that GB business can apply for a provisional authorisation under the UK trader scheme, so that no tariff would be payable. So that's going to be very important for the GB business to understand, to talk to the Northern Ireland customer and understand where those goods are going. Can I get the next slide, please? Thank you. So finally, just to finish off on Northern Ireland and leave us some time for questions to recap on VAT. So Andrew and Marissa have very eloquently explained the VAT implications in the UK, in GB and the EU post the 1st of January 2021. The VAT position for Northern Ireland businesses is again different. So Northern Ireland has to follow the EU rules on goods and the UK rules for VAT on services. So what that means in practice is that we will continue to account for all sales across the UK on a single UK VAT return. So if you are a NI or GB business at the minute that has sales in Northern Ireland and GB, that will continue as is. If you are selling from NI to GB, you will charge UK VAT. Selling from GB to NI, you will charge UK VAT with no change. One of the first changes is on moving your own goods from GB to NI. On moving your own goods from GB to NI, there will be a requirement to account for UK output VAT. So if we go back to the example of the business in Bristol that's moving the goods to Belfast, previously if they had one VAT return, they could move the goods from Bristol to Belfast and there would be no VAT implications. From the 1st of January 2021, they will need to account for output VAT on that movement of goods, and provided the goods are used for trading valuable purposes in Belfast, then they can reclaim it as input VAT. So it may well be an in and out on the same VAT return, but you need to watch out for things like partial exemption, because that would give you a slightly different outcome. Similarly, for UK VAT groups, there's normally a VAT disregard for VAT VAT groups within the UK, in that the goods can be moved from one company to the other without incurring a VAT charge. That disregard is again ignored where the goods are moving from Great Britain to Northern Ireland. So the company or the business within GB would need to account for output VAT on the movement of the goods, and the business in Northern Ireland would then have an input VAT. The last change, just to mention briefly on VAT, is specifically applicable to Northern Ireland businesses, and it's a change around the margin scheme. So Northern Ireland businesses from the 1st of January will not be able to apply the margin scheme for sales in Northern Ireland where the goods have been purchased in Great Britain. So this applies primarily to car dealers. So we've seen, for example, second-hand car dealers have an issue with this, where second-hand car dealers in Northern Ireland would typically buy cars using the margin scheme in Great Britain, bring them back to Northern Ireland to the showroom here and sell them, and again apply the margin scheme. They are now not able to do that. They need to apply standard rate of VAT, and that has a big impact on their margin. So that's a particularly large issue for car dealers at the minute. If we look at then NI to EU, so Northern Ireland for VAT purposes is still treated for goods is still treated as part of the EU. So therefore, for NI businesses where it's a business-to-business sale, if we're selling to the rest of the EU, we can zero rate that sale and it will be reverse charge for the business in the EU. Where the EU business is selling to us, they can reverse charge that sale to us in Northern Ireland as long as we give them our XI VAT number. So that's your normal VAT number with an XI at the start of it, and you need to have told HMRC that you're operating under the Northern Ireland Protocol and are entitled to use that XI prefix. So again, that's something that you should do as soon as possible if you're going to be making any acquisitions from the EU, so that they'll be able to zero rate that sale to you. And with Northern Ireland businesses selling business to customer in the EU, or EU selling business to customer to Northern Ireland. Again, it's as is, because currently we're still within the EU following the same rules. As I think Andrew already alluded to, those rules are going to change in the EU on the 1st of July, but for now it's really business as usual with EU VAT. And with that, I'm going to hand back to Alison just to sum up.
Wow, Angela, that just, you know, that's just crazy. And there's going to be so much to do in Northern Ireland. Maybe all UK businesses should consider getting a Northern Ireland business premises. That might be a good planning route in. But, you know, there's so much complexity there that, and you know, I do this for a living and I'm thinking, wow, that is a lot to get our heads around. So let's go back to the real basics to try to get a grip on how we take this forward and how we begin to implement. And it's back to the basics that we've always talked about, which is have a look at your pricing and your supply chain. Those Incoterms are so vital and they're so critical to determining the VAT issues that we've discussed, and who's going to be responsible for those declarations. And as Marissa said on many occasions, check your partners in customs and logistics and those agents. Make sure that everything is set up. Do you need to make any changes, particularly those important customs agents in direct representation? And also go back to those contracts when you're talking about Incoterms, because otherwise you may be pushed into a VAT registration in a country because you're delivering duty paid when you didn't think you would be. So go back to basics, get all those formalities arranged, and that's a starting point, isn't it? If we go on to the next slide, and then we'll all come onto the screen and answer a few questions. And we've got about another 70 questions to answer, and we've already answered about 30 of them already, I think. So post-Brexit, here we are. We've been talking about it for 4 years. It's actually happened. We now have to implement it, don't we all? We're here to support you. You know, we were already talking to clients about doing post-Brexit checks and walkthroughs, looking at their supply chains. Are your systems able to cope with an overseas VAT registration? Can you generate those invoices? How do we make that work within your existing accounting system? What paperwork is required? You know, how do you make your invoices work for Dutch VAT, for example? Can we help you with VAT registrations in Europe? Have you done your postponed VAT accounting? Actually, one question that was asked was, there's a bit of a maybe misunderstanding that postponed VAT accounting is only for 6 months. It isn't. It is a permanent thing, so well worth getting on top of. As you can see, we've got Marissa here from Baker Tilly in Europe, and we have our other colleagues around Europe who can help with all VAT compliance and VAT registrations. Andrew, with his custom support and those origin rules, amazing that he's able to make that understandable to us all, because it's so complex, and he's here to help you with that and those important customs regimes. And just a reminder that there is still grant funding available from HMRC for organisations to be able to receive customs training, which we deliver. It's £1,000 per organisation, or £1,500 per employee if you're doing your own declarations. Andrew told me yesterday that the £80 million pot of funding that was put aside is running out quickly. So it just goes to show just how important this training and that grant funding support is to businesses. So shall we go to sort of all screen, and we'll take just a few questions, and we will get back to all of you. So if I read out a couple. Oh, sorry. There are lots of questions for Andrew, which I think, and they're very, very complicated ones, which we'll probably have to come back to. Let's have a look at this one from Jane. We have a UK client selling goods they manufacture in the UK to consumers in the EU for around £200. Is it correct that they will have to register for that in each EU country they sell to? Jonathan, do you want to take that one, as it's a, or Marissa?
Yes, of course. If goods are sent to consumers in the EU, and the goods are sent from GB to the EU. Of course, the first thing that must happen when the goods arrive in the EU is the goods must be custom cleared. The question is, who is responsible for that? Will you make your customers responsible for that? Or will you, for example, arrange a centralized import solution to, let's say, the Netherlands, import everything in the Netherlands, and then sell the goods onwards to your customers, to the consumers? Of course, you must then register for VAT in the Netherlands and comply with the local reporting obligations, but you relieve your consumer customers from all the customs duties that could be charged and any import VAT that could be charged, and you relieve yourselves from any other VAT registration in another EU country. But because be aware that if you are going to import goods in your own name in multiple EU countries, you might need VAT registrations and sometimes even VAT representatives in all these EU countries. So centralization is the key in that. Thank you, Alice.
Really good point. Thanks, Marissa. Okay, question for Andrew. If we have a European subsidiary based in France who import our products to sell into Europe, will they need to apply for a REX number if they are returning goods back to the UK?
So the goods are going into France. If it's the French company that are doing the work and then exporting it into the UK, then it's the French company that would need the REX, because they're the ones doing the work. It wouldn't be the UK company.
Yes, thank you. Sorry, there are so many questions and they're all quite complicated. Here's a nice one. What happens to Intrastat and EC sales lists after the 1st of January 2021? Anybody wants to take that, or shall I take it?
I'm happy to.
Yeah, thanks, Jonathan.
So for GB, for Intrastat arrivals, they will continue to be required throughout this year. If I go wrong at any point, I've got enough people on this with me who might be able. And that's because you can defer your import declarations for up to 6 months. The HMRC want to be able to track those movements. So Intrastat arrivals will continue into GB throughout this year. Intrastat dispatches are gone for GB, as are European sales listings. But for Northern Ireland, Angela, I believe that everything remains in place for the next 4 years. You're on mute, Angela.
Sorry. Yes, absolutely. Everything remains in place as is. So you still need to do the Intrastat, you still need to do the EC sales lists. And the 4 years is because the Northern Ireland Protocol will be reviewed in 4 years' time. So in 4 years' time, there's the opportunity that you to either renew the protocol, keep it as it is, or change it. But yes, for now, everything is as is, still required.
Thank you. Question here for Andrew. Is sufficient process only proven by a change of the first 4 digits on the commodity code?
Normally, yes, because that's if you're just incorporating 2 products that are the same commodity code, then it might fall under the insufficient process. So if you're potentially just mixing or something like that, then yeah, it wouldn't be sufficient process. All you're doing is putting those 2 items together. So normally it would be the change of tariff heading. So if you imported a screw, although it's you're just screwing it into a finished product, it's changing the tariff heading because it's becoming that finished product. So generally it would be.
Thanks very much. I think at this stage, I think we've run out of time. We are very grateful for you joining us. We are aware that we still have a lot of questions to come back to you on, which we will do. And please do contact any of us if you've got any queries. I believe that Sarah will be sending round a recording and our slide deck, because I think that has been requested. And I'm sure on behalf of all of us, we wish you luck for the coming year.
Yes. Yes. Thank you for listening.
Thank you very much.